So today, I would like to share with everyone the learning journey for buying a call option. This is not financial advice, it's just a record for myself to accumulate the option learning experiences. So, there are different purposes to buy a call option. So, the first one is that you might want to close the call option before expiration just to take advantage of the premium rally. The second one is that you're actually going to wait for the call option to expire and then to take over the underlying stocks. But today we're just going to look at the first choices to close the call option before expiration. So in this case, you might want to choose those underlying stocks that are expecting an upcoming short-term momentum, right? So there are different scenarios to fit in this case. So at first I was looking at Nvidia because we know that it's expecting an upcoming earning report rally. But after chatting with Gemini, it's actually saying that right now Nvidia is not really a good entry point for buying a call option. We're gonna investigate in details why is that the case. But there are other cases that Gemini mentioned that is at a good entry point now, namely Microsoft. We're also gonna investigate in details in a short moment. So for buying, so therefore, this one, right, is actually not necessarily always the right case for upcoming year rally, right? Just remember that. But then let's say that in any case, you assume that the underlying stock is going to have a strong short-term momentum. Then in this case, you need to make two decisions. So the first one for buying a call option is its expiration date, right? The second one being setting up its strike price. So for expiration date, Gemini mentioned it's better to get it for 45 to 60 days. The reason being the aggressive time decay actually kicks in from within 30 days. So in this case, if you set it for 45 to 60 days, it leaves you about 2 weeks to wait for a strong price rally. So hopefully you can sell the option before the expiration date, right? But of course, there are some other cases, exceptions. For example, what if like you actually betting on the really exploding earnings report, right? In that case, you might be very aggressive to buy something within 30 days. But this is not the topic for today. Maybe we're gonna investigate another day. And then the second one being making a decision on the strike price, right? So Gemini suggests to set a strike price when the delta is around 0.6 to 0.7, right? So delta just means that it's the change of your premium for every dollar of price increase. So in that case, for every dollar of price increase, it contributes over a half of your value add to the premium, right? So therefore it's really a strong impact whenever you have $1 of price increase, and that kind of can offset the time decay kicking in, right? And then for delta being 0.6 to 0.7, then it means that it's slightly in the money, because we know that in a call option, strike price just means that the price you're gonna buy at expiration, right? So therefore, the lower the better. And also, it means that you will have to pay a higher premium because you are really gonna be able to take advantage of the price valley at the really low price to buy it, and then you can gain a big profit immediately after you sell it at expiration. So therefore, when you actually buy a strike price for call option that is actually lower, you're gonna gain way more for the short-term price rally, right? Especially, if the delta is kind of 0.6 to 0.7, then it's gonna be a huge gain for the momentum run in terms of its impact on premium value adds, right? So therefore, sometimes it's worth of the higher premium price you pay upfront because its slope of increase may be actually bigger than the premium price you paid upfront. And also, Gemini also mentioned the scenario for cutting losses. So usually is that when the underlying stock price breaks down below 20-day EMA, in that case, you might want to actually close the call option to cut losses. So, So then we can actually look at a few examples that Gemini mentioned that is having a good entry point for buying call option, right? So it mentioned that the best scenario is that is what Microsoft is having now, right? So you can see that the blue dash line is the 20-day EMA, right? So for the entire first quarter of this year, 2026, Microsoft has been running below the 20-day EMA, but then it actually just recently broke out when April started. It has been running above the 20-day EMA, but then recently it had to pull back again to test the support of the 20-day EMA. So in this case, it's actually the best scenario that when you see it's pulling back for testing the support 20 EMA, then you can probably bet that it's gonna have a bull run from here off the 20 EMA upward. But if it does not go as you expected, then you should just execute the loss cutting whenever the underlying stock price breaks down below the 20-day EMA. So 20-day EMA is really a crucial point in Gemini's explanation. And right now, and for we know that like MU, it had the really bull run right now, so therefore it's not really suggesting for a call option because it's probably too risky or having a low probability to have another huge rally for you to gain extra on the call option. At least that's what the Gemini recommends. And then we would also want to look at what Nvidia is doing right now, right? You can see the above curve right now here is what Nvidia is having. So you see that it's just running way off, way above the 20-day EMA. So therefore it's, and then also, even though its RSI is still within the 20 to within the 40 to 70 range, which is around 63.65 up to last night, right? But then it's actually closer to the overbought territory of 70. So therefore, which just means that, like the momentum is probably technically extended. Of course, with the recent, bull run, there might be exceptions, but in general, theoretically, right now, it's kind of like risky for buying a call option right now. All right, so I hope that kind of like clarifies my own confusion about what kind of time frame I should buy for a call option, and also how to really decide on the strike price. Of course, I might actually just experiment a little more on different scenarios, and then I might also update on that journey. All right, so that's good for now. Bye.